So we have some observations. The first observation, we say that the China government is want to segregate the implicit and explicit debt. The explicit debt, which raises by the local government through the LGFV, and this kind of debt, actually, in 2018, the Chinese government and pushing by the central government, and they review how much the debt they own, and they in the past raises for the public project, and those kind of debts is really should bear by the government, but they want to separate them with those debts that they are wasted for the commercial reasons. And the second observation is that we see in the short term, the China government willingness to support the LGFV is still high, because the strategic position, and the LGFV has undertaken more of the infrastructure investment for the local government, and also to support the economic for the regional government. And we see that the way to support the LGFV is changing from more directly to a indirect way. We see that the government are injecting access and also injecting capital or providing some operating subsidies to the LGFV, rather than in past they may directly inject the money to repay for the infrastructure project. And we also see that the aims to provide that kind of support is to help the LGFV to diversify the revenue source, which can support to generate the sufficient cash flow to repay for the debt. But it depends on the what kind of assets that the government owns. In some good regions, we can see that some listed stock sharing and that kind of assets that have high liquidity. But in most county level government, they don't have any access at all. Maybe there's some access with low return, such as the right of land, or some kind of the assets that cannot provide the sufficient cash flow. The third observation is that we see the credit divergence still high amongst different regions. As Terry mentioned, that you see if a good regions, they have more financial resources from the bank, and that kind of regions, the issuers are stronger than the others, even though the county level government, county level LGFV, they can enjoy the benefits of low interest rate and also the liquidity. But for those regions that are bad regions, that means they are low economic growth, or they has raised a lot of debt in the past, so the debt levels is high, and some of the government also invest aggressively in the infrastructure. We see some projects that they build a sports center for $1 million, but the return is nearly zero. But those still count for as a commercial debt at that time, and that make a lot of government actually they cannot support the repayment of the debt. And last but not least, we see that we believe in the long run, the LGF will return to like an SOE, the simple SOE, which means they will transit to a more they will bear more market-driven business. So this kind of if they are going to be a simple SOE, that means they will delink the LGFV credit from the local government credit,